Welcome to our CFP exam prep discussion on portfolio performance measures. Today we're diving deep into evaluating risk-adjusted returns, focusing on three critical measures that often appear on the exam: the Sharpe ratio, Treynor ratio, and Jensen's alpha. Let's start with the fundamental concept that raw returns alone don't tell the whole story. Portfolio managers need to understand how much risk they're taking to achieve those returns. This is where risk-adjusted performance measures come into play. The Sharpe ratio is probably the most widely used measure, and it's crucial to understand it thoroughly for the exam. Think of it as measuring excess return per unit of total risk. The formula is the portfolio's excess return divided by its standard deviation. For example, if a portfolio has a return of 12%, the risk-free rate is 3%, and the standard deviation is 15%. The Sharpe ratio would be 0.6. A higher Sharpe ratio indicates better risk-adjusted performance. Many candidates make the mistake of confusing the Sharpe ratio with the Treynor ratio. While they seem similar, there's a crucial difference. The Treynor ratio uses beta instead of standard deviation as the risk measure. It measures excess return per unit of systematic risk only. For instance, if the same portfolio has a beta of 1.2, the Treynor ratio would be 7.5%. This tells us how well the portfolio performs relative to market risk. Jensen's alpha takes a different approach. It measures the actual return versus what the portfolio should have earned given its level of systematic risk. A positive alpha means the portfolio outperformed its expected return based on the capital asset pricing model. For example, if a portfolio earned 15% when it was expected to earn 12% based on its beta, the Jensen's alpha would be 3%. A common mistake on the exam is not recognizing when to use each measure. Here's a practical way to remember it. Use the Sharpe ratio when comparing portfolios with different types of investments or strategies. Use the Treynor ratio when comparing portfolios within the same asset class. Use Jensen's alpha when you want to determine if a manager is adding value through security selection or market timing. Another frequent error is misinterpreting negative ratios. A negative Sharpe or Treynor ratio doesn't necessarily mean poor performance. It could occur in a year when returns are below the risk-free rate, which happens during market downturns. Here's a real-world application that often appears on the exam. Imagine comparing three mutual funds. Fund A has a Sharpe ratio of 0.8, Fund B has 0.6, and Fund C has 0.9. While Fund C appears to be the best choice based on risk-adjusted returns, you need to consider other factors like investment objectives and constraints. Remember that these measures have limitations. They assume normal distribution of returns and use historical data, which may not predict future performance. The exam often includes questions about these limitations, so don't forget to consider them. For calculations, focus on understanding the components rather than memorizing formulas. Know that excess return always means return minus risk-free rate, and that risk measures can be either standard deviation or beta, depending on which ratio you're using. These performance measures are fundamental to portfolio management and frequently appear in complex exam questions. Master these concepts, and you'll be well prepared for this portion of the CFP exam.